All right, great. Well, welcome everybody. Today is August 14th, and we are in the midst of election season. We're also in the midst of what I think is probably most likely the second correction of this bear market. And and so today, the objective of the discussion today is to kind of walk you guys through, all right, where are we so far in this bull market? What are we going through right now? What should be your expectations of this bull market as we move forward? And then, of course, the big topic, what will the impact of the election be on your portfolio? And what are the things that I'm looking at? One of the things that I'm going to try to convince you of today, as I've mentioned in the past, is that the result of the election will not change the direction of the economy and thus will not change the direction of the stock market. So that's what I'm going to try and convince you of. So we'll see how I do. All right. So as I said, I think we're in the midst of the second correction of this bear market. The first correction happened almost exactly a year ago. It was in the summer of last year. We saw over a 3-month period of time the market drop more than 10% last summer. Okay, we saw from July, August, and September the market dropping more than 10%, and then it took another several months after that to reach new all-time highs. So that was about a 6-month cycle, which is actually very, very normal. Okay, you can see that here. This is sort of the bull market that we've had so far. Okay, so to the far left of the chart begins the bull market in October of 2022. Okay, you can see the first correction right in the middle of the chart. That was last year. Okay, and then of course, after a few months, we were setting new all-time highs again. That activity continued until just very, very, very recently. The market's previous all-time high was established on July 15th. So July 15th. So just about a month ago, we hit an all-time high, and then the market started dropping, including some really dramatic drops. About a week and a half ago. But then you can also kind of see it's a little hidden here, but the market bounced back very, very, very quickly. And so the reason I kind of said second correction question mark is because technically, if it bounces back very, very quickly and ends up setting a new all-time high, it won't be technically referred to as a correction, but I think for all practical purposes, we can treat this as a correction. And as my email from a little more than a week ago, indicated, I really see these corrections as buying opportunities. I told all of you guys, hey, if you're sitting on cash that you're not going to need for some sort of short-term goal, right? It's a great time to get it invested in the market because it's like Prime Day, right? It's like Prime Day. Everything went on sale, so stock up, pun intended, stock up, right? So that's kind of where we are right now. Now, what to expect during any bull market, okay? Now, bull markets tend to last about 5 to 7 years on average, okay? And in the absence of information to the contrary, it usually makes sense to plan on the average, right? Plan on that 5 to 7 year period. So if this is year 2, we probably have another 3 to 5 years of bull market to go, okay? And typically in a bull market, what we see is we see higher than average returns in your portfolio. Okay. And that's really important because we need those higher than average returns during the bull market to offset the negative return in the bear market. Okay. And so if we have, low double-digit return for the next 3 to 5 years, that will help offset, a negative 15% return or something during the next bear market, to bring you guys all to that average target return that we've set for you based on your risk tolerance, right? Okay, so that's kind of how that works. Now, along the way, you should absolutely expect we're going to continue to have corrections. Corrections tend to occur every 12 to 18 months on average, right? During the 10-year bull market from 2010 to 2020, corrections were actually occurring much less frequently than every 12 to 18 months, but we've also seen periods of time where they happen more often than 12 to 18 months. So again, they're just a normal part of every bull market. And then, of course, as I've been saying for almost a year now, it is an election year. And so we should expect to have more volatility than normal. That means the down days are going to be further down and the up days are going to be further up, just resulting in a lot of up and down. But it's not going to stop the overall trend of an increasing, growing, upward moving bull market. Okay. Now one important question to answer is, why do corrections happen in the first place, right? It's not some like magical, overlord who is now creating corrections, Zeus on high or something. What corrections are is it's a response to new information, usually economic data of some kind. It's a response to this new economic information, okay? Because at every point in time, today, yesterday, a month ago, 6 months ago, at every point in time, there's some level of probability that a recession will occur. Okay. Now, that probability is simply a perceived expectation from the aggregate of all investors, right? So if you take the millions of investors and weigh their individual thoughts about the probability of a recession, and you put all that together, you get some aggregate probability of a recession. So let's just say that today's probability of a recession in the short run is 35%. Let's just say, I'm just making that up, okay? Well, a correction occurs when some new piece of information comes out. It might be an unemployment report, it might be an inflation report, it might be a corporate earnings report. It's some piece of economic data where then all of the sudden in aggregate, people look at that data and go, oh, maybe the probability of a recession is actually higher than we thought it was going to be. Maybe it's not 35%, maybe it's 45%, okay? And what that means is if the probability of a recession all of a sudden jumps, the expectations for future profits from companies, gets cloudier, right? It gets worse. Expectations of future profits get worse, thus reflecting a drop in stock prices. Okay, because stock prices today are based on two things: profitability of companies today and expectations of profitability in the future. Okay, so if the probability of a recession goes up, expectations about future profits also, get worse, thus a sudden drop in stock prices. Okay, and then what often happens during a bull market is more economic data comes out. Okay, so like today, let's say we're in this second recession, or second correction. Today we're in this second correction, right? As more and more economic data comes in that shows that, oh no, actually we were probably right before, that in aggregate the probability of a recession isn't 45%, it actually is more like 35%, or maybe it's even 30%, right? As more economic data comes in, expectations of future profits go back up to where they were, and thus stock market prices continue to go up and the bull market continues. Okay. Now, eventually, what will happen is one of these corrections will actually turn into an actual recession, right? We will get economic data that shows a recession is more probable. And rather than that probability going back down, the probability will become true, right? And a recession will actually happen, and most often a bear market will occur, right? So these are sort of the three different types of drops we can have in any stock market. Okay, there's the correction, which is what we're talking about. That is a temporary change in stock prices reflecting concerns about the probability of a recession. Then there's the bear market, which is most often a reflection of an actual economic recession. Okay. And then there's the crash, which we haven't really had a crash since COVID, but the, crash is like a sudden shock, because of something dramatic happening, right? Like, we're talking 9/11, we're talking COVID shutdown, we're talking, like Black Monday kind of thing, right? We haven't had crashes in this, most recent bear market of 2022 or bull market so far. Okay. Okay. So what you actually really came to talk about. All right, let's get into it. Let's talk about the election. Okay. The election in your portfolio. Okay. So I'm going to put it out there right now. My opinion is the result of the election is not the most important factor to consider in the market. I'm not saying it's not a factor. Okay. The election absolutely is a factor. It is one of the variables, but it's not even close to being the biggest variable. Okay, not even close. And as a matter of fact, I believe it is so small of a variable that we can pretty much disregard it in terms of how we manage your portfolio. Okay, that the result of the election should not change how we manage your portfolio either before or after. And my goal is today to give you the information so that you see things from my point of view, or at least go, well, I don't agree with Jon, but at least he's proven that his point is valid, right? So if I can at least do that, then I feel like I've accomplished my goal. So let's get into it. Let me show you why. All right. Whoops, wrong way. Okay, so I want you guys to take a minute and look at this chart. All right. Here is a chart of the US GDP, okay, which is the best kind of measure of economic activity in the US. Okay. And this chart goes all the way back to 1982 with the start of President Reagan's presidency, all the way up through the third and a half year of Biden's presidency right now. Okay. And who here can spot the pattern of Democrats and Republicans and economic growth? Okay, it's really hidden. It's hard to find. Okay, I'll just tell you the hidden secret is that the economy grows no matter who is president. Okay, it just keeps going up. Okay, and not only does our economy continue to grow no matter who is president, right? It continues to grow without a ceiling. Okay, there is no magical ceiling about how much the economy can grow, and I do hear it all the time. I hear clients and business partners tell me, well, how can it get any higher? How can these stock prices just keep going up? And it's because there is no ceiling, right, on economic growth. This is a sign of capitalism doing what capitalism does, which is allowing an entrepreneur to take money in the form of capital, take labor, take resources, and use it to produce a product or service that people want. Okay, and there is no limit to how much that process can work, okay, to increase all of our standards of living and our life. Okay, and so now I want to take this chart and I want to juxtapose it against now the stock market. Okay, because the economy is not the same as the stock market, though most of the time the stock market is a reflection of the economy. Okay, so now here's the same chart with the S&P 500. Okay, and who can spot the trend? Okay, I'll tell you again, the trend is it doesn't really matter who's president. The stock market tends to go up, right? There are periods of time, of course, where the stock market drops. We all know the stock market drops, but it is not dependent on whether it's a Republican in office or a Democrat in office. It does not make a difference. Okay, it does not impact the direction of the stock market. And you can see none of these elections, right? None of the changes in these pictures have coincided with a sudden change in the direction of the stock market. And some of you might be going, but what about the Obama one? What about the Obama one? And I would just like to indicate that Obama took on his presidency 5 months into the Great Recession. Some of us suffer from the Mandela effect, where we associate Obama with the Great Recession when truly the two did not coincide. Okay, it was essentially the last 5 months of the Bush presidency and that began the Great Recession. And just as you shouldn't associate Trump or Biden with the COVID crash, right? It doesn't make any sense. Okay, so what I want you to take from this chart is that the trend of the stock market continues going up, no matter whether there's a Republican or Democrat in office. Okay, so now let me get even more specific about it. All right. Okay. So now here are the stock market returns for the S&P 500 for the first 4-year term of every president since Reagan. Okay, and I've put them in order here. Okay, so if you thought Democrats were bad for the stock market, sorry, Obama and Clinton actually rate top as far as stock market performance, during the first 4 years of their presidency. Followed very closely behind by Trump and George H.W. Bush. Okay, matter of fact, the only president who experienced a drop in the stock market during the first 4 years of their term was George W. Bush, right, with a negative 13.5%. And that's because he took over right during the tech bubble, and he finished his presidency right in the midst of the financial crisis, right? So, it's not even a fair judgment, nor would we call it his fault, right? Now, this list does not include Biden because it represents an entire 4-year term. But if we just wanted to look for the first 43 months of a president's term, we can now see Biden fits right in the middle, right? Okay. So again, there is no trend here of Republicans are better or Democrats are better. The one thing we should take from this chart is, what's really good for the stock market? Time. Time is really good for the stock market. If you leave your money sitting there for 4 years, it's probably going to be up, no matter who is occupying the Oval Office. Okay. And now finally, let's get really crazy and let's go back to all the modern presidents of the 20th and 21st century, starting all the way back with, I think we go as far back as Hoover on this one. Okay. And again, the most important thing I want you to take from this chart is, if I leave my money sitting in the stock market for 4 years, okay, no matter who is president, okay, there is a very, 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 very good chance I'm going to experience a positive return, okay, and maybe even a really, really great positive return. But on average, if I leave my money sitting there for 4 years, okay, most of these presidents delivered about a 6 to 20% annualized return. Okay, right? Carter, right? Carter is remembered as being president during really horrible economic times, right? High inflation, all that stuff. And yet, money sitting in the stock market still had a 27% return during that 4 years. Now, that might not be an inflation-adjusted 27% return, but it's still a positive return nonetheless, okay? And a matter of fact, averages about 6% per year, okay? All the way up to, Clinton, Obama, Eisenhower, Roosevelt, where you've got these huge 20+% annualized returns. And again, the only presidents that presided over a negative drop in the stock market, Truman, which was basically flat, George W. Bush, and Hoover. But, those are really good odds in my mind. Okay. All right. So again, what I want you guys to take from this so far is that time in the market is a much more important factor on what your return is going to be than who is the president, and that none of these presidents, right, created an apocalypse in our economy. Okay. And every single president, the GDP grew, continued growing, capitalism worked, right? And it's just not going to change the direction of the economy. But now, what can the president do that is a factor? Okay, because I said at the outset, it's not like they have nothing to do with the economy and thus the stock market. Okay, it's just that it's not the most important factor. Okay, now what I look for in presidential policies affecting the economy and the stock markets is I'm essentially looking at three things. Okay, tax policy. Okay, most especially corporate tax policy, much less than individual tax policy. I'm looking at trade policy, okay, because trade is trade is kind of the engine of the global economy, okay? And the smoother that engine is working, the better overall. Okay, so I am looking at trade policy, and the president pretty much single-handedly controls trade policy. And then the potential for an economic impacting war, okay, which is a very, very, very small chance, and I'll show you why. Okay, so let's dive into it. Let's talk about tax policy. Okay, so I'm going to make this bigger. There's probably way more here than you ever need to digest. Okay, but this was a reputable analysis done of Biden, and I'm sorry, I know it's Biden, and I know he's not the presidential candidate anymore, but I couldn't find anything that was updated with Harris's proposals. But I think we can be pretty confident they're going to be relatively more or less in line with Biden's proposals. Okay, so here's an analysis of how Trump's tax change proposals, and Biden's tax change proposals lined up against other major tax law changes in history. Okay, so the biggest tax law changes in history, okay, are at the top here. One was a gigantic tax cut in 1981, the Economic Recovery Tax Act of 1981. Okay, the size of that tax cut was about 3% of gross domestic product at that time. Okay, pretty big, 3% of GDP. Okay, was the amount of that tax cut. The largest tax hike in history was in 1942, the Revenue Act of 1942, which essentially created Social Security. Okay, and then of course there was a Revenue Act of 1941, Revenue Act of 1951. Right, these are all the New Deal. Okay, these are all the New Deal proposals and the ones that followed. Okay, huge. Okay, now on the tax cut side, we can see that President Trump's proposed tax cuts are significant. They're significant. About 1% of GDP is what those tax cuts represent. Okay, and then he's also got another sort of tariff type tax hike of another 0.5% over here, and then President Trump has another proposed tariff tax hike of about 0.7% over here. And you might ask, well, how can tariffs be on the tax cut side and the tax increase side? And the answer is it depends on who they're hitting. Okay, you can decrease tariffs for some American companies, and you can increase tariffs on other American companies, and so that's why it's on both sides of the ledger. Okay, President Biden, he has proposed a relatively dramatic tax increase, but it still only represents about 0.9% of GDP. Okay, so if I add up all the numbers, right, Trump's proposed tax cuts offset by Trump's proposed tariff hikes, okay, I get about a 1% change in GDP. Okay, and Biden's proposed tax hike is about a 1% change in GDP. They're just in different directions, right? Trump's is a net tax cut of 1%. Biden's is a net tax hike of 1%. But again, it still only represents 1% of GDP. Okay. At the same time that we're squabbling over these 1% changes in GDP, the Fed is currently holding, okay, bonds equivalent to about 27% of GDP. Okay, that's how much power the Fed is holding in their hands right now. Okay, so do I ignore the proposed presidential tax policies that maybe sway it plus or minus 1%? I don't ignore it, but they are just proposals and they still have to pass them. And we have no idea what they're going to look like afterwards. And still, at most, we're talking a plus or minus 1% versus watching the Fed, which is actively making decisions about 27% of or debt equal to about 27% of our GDP. So again, it's just so much bigger of an impact when we look at the decisions the Fed is making compared to the tax proposals that the president is making. So those are my thoughts on tax and tariffs as they stand right now with the presidential candidates. And again, I realized this was an analysis of Biden and not Harris, but I had to deal with the information that I had available to me. I still think it's valuable. So let's talk about war. Okay. So the president has a single authority to declare war, and I've heard a lot of concern from clients about the conflict in Ukraine, the conflict in the Middle East, the potential of the conflict in the Middle East spreading, and I keep saying, yes, it's a horrible, horrible, life-destroying thing, but it's not going to make a difference economically. Okay. And I just want to show you why I continue to say that. Okay. So here's a chart of basically every conflict we've had in the modern era compared to the S&P 500. Okay. And one thing you can see kind of very quickly, very clearly, it's that none of these conflicts have really changed the US stock market meaningfully. I mean, the Afghanistan war, well, that was really more 9/11 and the tech bubble bursting. That really had nothing to do with the Afghanistan war. The Russia-Ukraine conflict wasn't even a blip on the stock market radar. The day Hamas attacked Israel, almost nothing happened, right? The stock market continued to go up. I think it's up something like 14 or 15% since Hamas attacked Israel. Okay, so when it comes to most war, most of the time it's just not that big of an impact. What can be an impact is if we end up getting into a infrastructure destroying, resource depleting, manpower depleting type of war. Yes, that will clearly have economic impacts, but almost every conflict of the modern era just has not had a large enough impact on the US economy to move the stock market. And that's just what the evidence shows, right? So, okay, so yeah, so the election is coming. Beware, the election is coming. You guys are going to continue to get bombarded 24 hours a day, 7 days a week from social media outlets, traditional media outlets, politicians, and then people who have a buck to be made, trying to convince you should panic, you should be scared, you should fear that if your candidate doesn't win, that our economic lives will be over, right? I talked to a client yesterday. He said, he was watching a news outlet, and the news outlet said, if Harris becomes president, it'll be the next Great Depression. And it's like, well, that's just stupid. Like, that's just stupid. There's nothing there. There's nothing real there. It's just hyperbole, right? It's just ridiculous hyperbole. Okay. And all of the evidence shows that it's just ridiculous hyperbole, right? Because we've been through much crazier elections than this. And yet, guess what? The lines just keep going up. The lines just keep going up, right? We survive. Economic activity continues. The stock market continues going up, right? So I just want you to know that you likely only have one person in your ear who actually legally has your best interests at heart, and that's Village Wealth Advisors. We are a fiduciary. We have a legal obligation to you to provide you advice and do what is in your best interest. And and Fox News and NBC and CNN and whoever you're watching does not. Okay. They have a buck to be made, right? They're making money off of your eyeballs glued to their television, scaring you half to death so that they can sell advertising dollars. Okay. And I'm the one here to protect your portfolio and protect your money. Okay. So what do I think is going to happen? All right. I think there is, and again, this is kind of like ballpark my opinion, right? I think there is probably a 75% probability, or maybe 70% probability, that the bull market continues, that we are not on the cusp of a recession. Okay, so I would gauge the recession probability today at 25%, maybe 30%, but actually I'm probably pretty comfortable at 25%. Okay, that's my own personal prediction, and I think that the stock market will continue to provide upside returns of 15 to 20% per year for the next 2 years. Now that doesn't always translate to a 15 to 20% return on your portfolios, okay, because your portfolios are not all in stocks, right? Some of you guys have more stocks than others, right? But the stock market piece of your portfolio, I believe, will generate 15 to 20% return on average over the next 2 years. I think the Fed is very likely going to lower rates at some point this year. I'm not quite as convinced that they're going to do it in the September meeting as other people are, but I think it's pretty safe to say that they will begin dropping rates, probably very slowly, beginning this year. Okay. Long-term rates, though, your mortgage rates and things like that, they will come down a little. They're not going to come down nearly as much as people think. Okay, we're not going to be seeing mortgage rates in the 5%, and we don't, frankly, really need to. Right, higher rates on bonds and thus mortgages are actually a really, really good thing for you guys, for my clients. Okay, because if we're getting a 6% return on bonds, that means I don't need to take as much risk with the stock piece of the portfolio to hit an average return, right, of 7, 8, 9%, right? If the bonds are carrying more than their weight, with some decent yields, right, that just works out much better for the investor class. Okay, and so not only do I not think rates are going to go down very far, it's in your best interest that rates don't go down very far, though a little bit of a rate cut will act as a stimulant for the economy. Okay, I think inflation is going to continue to slow. I think we continue to see that, and again, I think GDP growth is going to continue to be positive and accelerating. So this is a very optimistic view of our economy and the future. Okay, that is it for my prepared remarks. Now, those of you who disagree with me fervently can have your moment to say so. So I will open it up to any questions. If you'd like, go ahead and unmute yourself, and we'll talk about your thoughts. All right. Any thoughts? Anybody? No questions?
Well, I'll just say that I'll say thank you for your insights. That was very clear, and I always love your way of analyzing things. So I think if anybody was having concerns about the impacts of current politics on the economy, that should have laid it to rest. So thank you.
Excellent. I convinced at least one. Thank you, David. Anybody else? Any questions? I'll leave a couple more minutes or another 10 seconds for anybody to ask questions, and then I'll just end the recording and send it out.
Okay. Hey, John.
Oh, hey, yeah.
Hey, tell me about how the emotional influence of people impact the market.
Okay, so great question. So consumer confidence is one economic measure of how people are feeling, right? There's a lot of others, and so it is important. It is very important because a pessimistic outlook, okay, if enough people have a pessimistic outlook, it's a self-fulfilling prophecy. Okay. And let's just look at it as business owners, right? Because business owners are what drive, expansions and recessions, right? So if I'm a business owner and I'm pessimistic about my profits in 2025, okay, I'm going to make certain decisions today to protect my business. I might not hire another employee. I might consider terminating an employee. I might not take on additional office space. I might decide not to buy a piece of machinery, right? All because maybe I want to preserve some cash because I have a negative expectation about what my profit might be next year. Okay. Well, if that one business owner, becomes a majority of the economy, right, who have a negative expectation and they stop investing in growth, economic activity slows down. Okay. And we go into a recession. All right. And so gauges of people's emotions give us some idea about what future economic activity might be, but it's not the end all be all. It truly isn't. And part of it is because we don't exist in a vacuum. Okay. The US is not in a box, right? We exist in a global economy. Okay. And so everything from currency valuations to import, export, and supply chains and conflicts overseas, all of those things have an influence on what actual economic activity ends up being. One of the things we've seen is that the dollar has become very, very strong against most foreign currencies. Okay, in some ways that's a really good thing because it allows Americans to travel overseas, and our dollars go a lot further. It makes the importing of goods a little bit cheaper. Okay, but it also very much hurts exporters. So whether we feel good or not, if all of a sudden the dollar becomes weaker against foreign currencies, okay, it can really expand our ability to export goods, right? Which can be good for a whole segment of the economy, regardless of how we happen to feel in the moment. Okay, so I hope I answered your question.
Okay, John, I have a question.
Sorta. Okay, yes, Steve.
Yeah, John. Okay, so you didn't touch on the national debt. Could you give us a few words as to how you think if we keep on borrowing money, how that will impact the economy
Yeah.
or us individually, or
Yeah,
how does that?
so it's funny that you asked me that question because I literally spent about an hour and a half preparing a slide on the national debt and deficit compared to GDP, and it started getting so complicated. I'm like, oh shoot, like I don't think I'm going to be able to explain this well enough that most people will understand. I think it's going to be overwhelming data. Okay, but that is one of the truths. Okay, since the 21st century began, okay, since the 2000s, every single president has run a deficit. Every single one, right? We have not had a surplus since Clinton, and we haven't had a balanced budget since before, since the early 90s and 80s. Both sides of the aisle have basically given up on trying to balance the budget. You'll notice even in the proposals, right? Sure, Biden proposed a tax hike, of 1% of GDP, but I didn't put up there what his spending plans are, right? And on the flip side, Trump proposed, a tax cut of a negative, net negative 1%, but he's also increasing spending too. So both sides of the aisle like to spend money, and they like to spend money faster than we pull it in. It's just a difference of opinion on what we spend that money on. So the budget deficit is only a problem if it gets so high that people stop thinking the United States will have the ability to pay it back. Okay, because even though the budget deficit has gone up, GDP has gone up also. Okay, and if you're familiar with the concept of arbitrage, right? Arbitrage is this idea that you can borrow for one interest rate and invest at another interest rate. Okay. And so if you can create a positive arbitrage where you borrow for less money than you can grow it by, then you win. Okay. If you have a negative arbitrage where you're having to borrow at a higher interest rate and you're earning a lesser amount, then that's bad. You have a negative arbitrage. That's a bad thing. Okay. Well, the US government right now can borrow at somewhere between 3 and 4%. Okay. Depending on what type of government securities you're looking at. Okay. But in general, it costs the government about 3 to 4% to borrow money. Okay. Our GDP is growing at about 3 to 4%. Okay. So right now we basically have even Steven. Okay. You know, our GDP is growing nominally, like the number that it grows by is much, much bigger than what the debt is growing by. Why? Because the US GDP, let's see, I have the numbers at my fingertips here. Let me pull it up. What is the US GDP? Oh, you know what? I didn't save it. Okay, never mind. I don't have it at my fingertips. So again, it's only an issue if one, the debt becomes so high that our investors, or the people who have lent money to us, doubt that we can pay it back, and it becomes so high that it's growing faster than GDP. Okay, those two things become a problem, and we are sort of kind of getting on the cusp of that. I mean, there's not a whole lot of evidence that anybody thinks we're going to default, because people still continue to be very happy to buy our debt. There's no other currency in the entire world that people are willing to buy more than our debt. It's still the safest investment in the entire world. But yeah, if it ever becomes not, it's going to be a big problem. I mean, when England kind of lost its position as the reserve currency, the pound lost its position as the reserve currency of the world, it caused significant economic problems throughout the UK for decades, right, that they had to deal with. And so, yeah, it's a potential worry. I don't think who is president is going to change it, because they're both proposing the same things. They both want to spend more than they take in. So, maybe eventually we'll get a Congress and a president that decides they do want some fiscal responsibility.
But as far as impacting the S&P, the index, it doesn't, right? The debt, level of debt.
No,
Okay.
no, it doesn't. I mean, the debt, the U.S. debt, just like all U.S. spending, is a drag on the U.S. economy. Okay, government spending is in net a drag on the U.S. economy. Okay, it's also a safety net, right? That's what we saw during COVID. That's what we saw during the financial crisis. Government spending can be a safety net. So during the very, very bad times, government spending is a safety net on the economy. But during the good times, it's just a drag. It's just a drag on the economy, right? But as of right now, it's not like such a drag that we're not growing, because we're clearly growing.
Okay. Yeah.
Okay.
Thank
Other
you.
questions? Yeah, Deborah, you want to ask another question? Go ahead.
Hey, Sherry, what's the number?
John, at Village Wealth, if a virus cyber attacks your company or Schwab, what is your recovery plan, and for the backup of getting us all back online and keeping our assets?
Oof. Okay.
I know it's a big question, but it's important.
It is. It's a big important question. Okay, so
And so keep in mind that most of us probably have some intellectual computer knowledge about how these things work a little bit.
yeah. Okay. So, I mean, I'm not going to be able to answer your question super specifically, because it's just way too far out of my area of expertise. Okay. But part of having an independent third-party custodian, which is what Schwab is, okay, part of the importance of that is that your money is not dependent on the functionality or the solvency or anything else of Village Wealth Advisors, right? Which we are a small business, right? And I can afford to spend about $60,000 a year on cybersecurity, but but that's like 3 less zeros than I'm sure Schwab is spending on cybersecurity. Okay. So, we in some ways are, well, like we all are dependent on the cybersecurity of the largest financial institutions in this country. Your B of A's, your Wells Fargo's, your, Charles Schwab's, right? And your Merrill Lynch's and all that. So I'm not an expert enough to say how well our largest financial institutions are protected against cybersecurity, but that's why we use that's one of the many reasons why we use a third party custodian, is so that Village Wealth Advisors cybersecurity is not what's protecting your money. Okay. So I know that's probably not a perfectly satisfactory answer for you, but I'd probably have to do more research in order to answer that question more completely. Okay. All right. Other questions? All right. Okay. Well, thank you so much, everybody. Thank you for attending. Please, if you
John,
oh yeah.
John, I'm sorry. I'm double dutying. I'm working and trying to listen, and I have listened to everything. It's Laura Bearer.
Hey, Laura.
Hi, it's good to see you. I had just one quick question. I understand everything you've said. I'm not worried about anything. And I understand that rates are not looking like they're going to go down. With regard to the real estate market, do you have any idea, anything you want to comment on there? If you don't, I totally understand, but any thoughts?
Yeah, well, the real estate market is extremely local, right? It's extremely local, right? So when we talk about the real estate market, we really have to talk about some specific locality. I can say,
how about right here?
Right here in Los Angeles?
Yeah, I would say even from the San Fernando Valley to Santa Barbara, if you want to make it that generic.
Sure. Okay. Yeah. So I think it's unlikely that we're going to see a lot of
price change.
Price decreases.
Okay.
I think the most likely scenario is that prices continue to go up.
Okay.
Simply because we still have a supply-demand problem, right? We have more people who want houses than houses are available. Okay. Combine that with the fact that you've got a whole lot of homeowners who are locked in at 3 and 4% mortgages who do not want to move.
Right.
Really really most of the activity we're seeing in the residential real estate market are people moving because they have to move. They're moving because of divorce, they're moving because of a death, right? Or they're moving because of a job change. Okay. They're not moving because they want to move, they're moving because they have to move. And so as long as that is still true, and as long as we're not building more homes, we're going to continue to see price increases.
Okay. That answers my question. Thank you so much. It's good to see you.
Good to see you too.
All right.
All right. All right, everybody. Thank you so much. This has been
Thanks.
wonderful. I really appreciate all your attention. And please, if you found this video valuable, please forward it along to somebody who also might benefit from it. We are here. We are ready to help. Any of your friends, any of your family, any someone that you know who is either looking to transition into retirement or manage their retirement assets and make sure that their money is protected and that their cash flow is secure. That's what we are really, really good at. And we hope that we can continue doing that for you guys in the future. So thank you so much, everyone. Take care. Bye-bye.
Bye-bye.